Thank you very much. And let me just say thank you very much to my friends at COEO for giving me the chance to talk to you today, because I think what I'm going to be talking about will resonate with most people in the room. So as it's just said, I am one of the directors of a company you've never heard of, KM2 Ethical Finance Ltd. I've no idea who that old git is, but you've got me for the next 20 minutes. So what I'm going to be talking about is our specialism, which is focused on abandoned debt portfolios. This is where they've gone through the dunning cycle, you've failed to collect on them, or collections have stopped for whatever reason. And what we're focused on is finding within that the deliberate credit abuse, or what's called in the industry first-party fraud. We don't talk about fraud with the consumers, of course, but that's the terminology that the industry uses. And I'm going to take these off so I can read my notes and also not spot who falls asleep. I'm going to be talking about fraud in a collections context, and I've brought with me some, not enough for everyone unfortunately, of a white paper that we've produced, which goes into a lot more detail on some of the bits that I'm talking about here. So if you want a copy of that, come see me, I've got a few. If I can't give you one printed today, I'll make sure that we get one to you electronically. So I'm not really talking about third-party fraud, where your consumer is the victim, or a third-party, random third party has had an account takeover, APP. It's not about that. This is about where somebody has been deliberate about stealing money from institutions. And it's every bit as much a growing industry as the rest of fraud. I've used, where possible, graphics rather than words, because I'm aware that not many of you will have brought opera glasses, so hopefully we can talk through these slides rather than have to squint at reading them. What we know about fraud, generally, first, second and third party, it's a constantly evolving landscape. The fraudsters change their attack vectors. You can never keep up with them. Just when you think you've sorted something, they come round behind you and find another way in. And so it's important to use a constantly changing and full suite of tools when dealing with them. So what I'm going to be talking about today, I'm going to go through some general fraud stats, but I'm going to try and canter through those, because even if you haven't seen these ones, you'll have seen similarly frightening ones. I'm going to talk about how that dovetails with what we've done with our friends at COEO on portfolios that have been written off, charged off completely and forgotten about. I'm then going to talk about front-end versus back-end protections and the challenges that come with that, the prevention versus cure. Talk about actual experience of the contracts we've done, and then looking a little bit into the crystal ball, some of the things that are around today, some of the things that are coming, and how we adapt to this. So just looking generally at here we go. Why is next not working? I've been pressing next.
No, okay.
Oh, there we go. That was the start of it. Here we go. This is back. Oh, all right.
See how you go.
So I've looked here at crime stats from the ONS on an index basis, so it's showing growth, not absolute values. And the index was March 2004, goes through to March of last year. Violence against individuals has climbed quite a lot. I think a lot of that is because we're talking about reported crimes here clearly, and I think crimes against women, unfortunately, have increased, and certainly the reported cases have increased a lot. No, back or forwards. Aha. Criminal damage, I think I may have got these two the wrong way round, so if I go to the next one. Yeah, why is this? There we are. Theft and criminal damage, maybe they're the wrong way round, I'm not sure, but they're broadly flat. There's that spike around the credit crunch time, which is why I think that might actually be theft, but you can see there's not a lot of change really over time there. Drug offences, interestingly, also pretty flat, a little bit down on where they were. As you can see, somewhere around about just after the credit crunch, I stopped using, that's why they dropped. The one that's really taken off, and exponentially, and it's only third-party fraud really, because first-party fraud is unreported. It's the lost part of the fraud environment. You don't tend to get stats on it, but it's huge, and it's just spiking up out of control, really. Some of the stats, so from the coalition, what's it actually called? The Coalition Against Insurance Fraud, 80 billion per annum in insurance fraud. Mainly that'll be first party, that'll be claiming for things that either didn't happen or inflating insurance losses. Payment frauds up 3 times. The number of organised crime groups in the UK, according to the NCA report in about, the National Crime Agency report in about 2020, nearly 5,000 of them, almost a fifth, were known to be involved in fraud. My suspicion is that's quite a lot higher that are actually involved in fraud. Synthetic IDs, I don't know if you've kept up with what's going on in this space. It's huge in America and it's coming over here. These are IDs that are typically used for first-party fraud. They mix up real data from an individual with data from another individual or falsified data to create something that can then be used multiple times in many cases to steal from institutions. And the Federal Reserve was estimating, and I think they're probably underestimating, the scale of the losses from this in US banks. I'll come back to that other graph from the University of Plymouth showing that average losses from fraud have gone up by about 55–56% in recent years. And an IET survey of financial institutions showed that more than 60% of them were saying they had found evidence within their customer base of synthetic IDs. So this is big business for criminals. And the thing about first party is it's quite difficult to identify, certainly in advance. Even during the life cycle, it can be difficult to identify. They look like any other customer. They can hide within your customer base, in any portion of that customer base, in any particular type of customer. They look like anybody else, they behave like anybody else, and they have all sorts of topologies which we go into in this white paper that make them very difficult to weed out during the collections process. They often get through to the end with a fabricated story. They've missed all the payments they promised to make, or they've been impossible to get hold of. And we come in and we use 2 parts to go after them. The first is an analytics piece, which looks at the data you have, looks at the data that bureaus can give us, melds that together and comes up with a score based on the pattern of their behavior, the losses that you've incurred, and scores them, ranks them from 1 to 999 based on 3 factors. What is the propensity that they were deliberate about it? They were a first-party fraudster. They've done it elsewhere. They've got a history of it. They've got a fractured ID they're using, something like that. What is also the propensity that that ID, or one that we can easily link to it, has resurfaced in the credit market? Because they don't make enough to go and buy a Caribbean island, they have to come back. They keep going. It's either the same institution or another institution, so you see them resurface, but possibly with slightly different credentials. And what is their propensity to pay? So our scores don't identify vulnerability, but they do identify likelihood of, or potential for vulnerability. If it's a low score, it's likely that that person is either a pensioner, low income, lots of things going wrong in their life, and they're more of a can't pay, rather than, as somebody was talking about earlier, the will not pay. We're looking for those at the top end, and we don't expect to get 100% of cash back on portfolios like this. We're looking at those where we've got credible information to point to the fact that they are deliberate about what they're doing and in a position to remediate on their past misdemeanors. And then we apply, and our friends from COEO can attest to this because they've been trained in it, a slightly different, nuanced collections conversation style with those people, still very much within FCA compliance, but is designed to get that debtor, that customer, to a position where they say, I need to make this go away. If this gets out into the wider world, if you marry up those two credit IDs with the bureaus, etc., I might have difficult conversations with other creditors. I might even, depending on what industry I'm working in, I might even have difficult conversations with my boss. I need to resolve this. I mean, I did have somebody actually email me saying, from the fraud department of a well-known bank, I won't mention the bank, saying, I need to make this go away. You get to that sort of conversation with people. So, looking at where we've actually, looking at the topology of a first-party fraudster, looking at preventing them from getting in the door is difficult. In order to do that, you need to know which of those two people is coming through the front door. What is their intent? Are they planning to take you for a ride? And you can't identify intent in advance in most cases. Indeed, they may come in as a good customer, and as a result of the experience over their customer life cycle with you, they understand that they can revert or become a first-party fraudster. They can get away with it. So intent can evolve. So you trying to stop them coming in through the front door, yes, you should do that, but you've got to recognize that it's not always going to work, because you're not going to be able to see who's coming in. But if you're looking after they've done it, at remediating on the money that they've absconded with, you don't need to prove that intent. And this was the first contract we did, not with COEO in this instance. It was too small, really. It was a rump-end portfolio, really quite poor debts. A lot of them were statute barred, we couldn't go after. But those that we did get hold of, our scores, our jackdaw scores along the bottom here, ranking those accounts from, we didn't even bother with the sub-500s, from 500 to 999, you can see that there's a very clear match. We're getting it right. And when we got hold of those in the upper score levels, it was a much easier conversation with the data we had, and we got quite a lot of money back, a lot more than I think people expected at the time, given the nature of the portfolio. We then did one with COEO. Very different portfolio, didn't have quite so many accounts in the upper end of upper echelons, but again you can see that although we were getting some money from the lower end, clearly the scores were having an impact on where we were collecting money. And independently, it was assessed at a snapshot point in time that we were 5 times more effective than just outsourcing to somebody. They'd actually outsourced much the same debt to somebody else, and we were getting 5 times better at that point, and that climbed to, I think, nearer 8% before it stopped. So it's actually adding value to the process. And I think it's important, I didn't press that time. It's important, let's go back to it. It's important to recognize, again, we're not going to get 100% of this money back, but if we can get money and data understanding how these people got to the position they did, whether it was initial intent or evolved intent, then that can feed back to those front-end defenses, and that can allow you to tweak the dials, as it were, and prevent, hopefully, more of those. And it's a constant, as we said right at the beginning, it's a constant process of learning how people are adapting to your controls, your systems, and making sure those systems adapt in turn, and make sure that you keep them out. So what does the future hold? Well, this is that University of Plymouth slide again. That sort of phenomenal growth is going to continue. There's no reason to expect that fraud is going to stop suddenly. And there are more incentives to it. Societal issues are huge. In the old days, if you said you worked in a bank, you were considered to be a pillar of the community. In fact, to tell a story I heard from, since discredited, but at the time Fred Goodwin was CEO of RBS, and he told a story that in the 1950s, if you were offered a job by RBS, you were expected to sign an indemnity to the bank. So if you screwed up, the bank could come after you. And such was the esteem that a job within the bank gave you in the community, your parents countersigned that indemnity. Now that's gone. I mean, that sort of level of esteem. Now, if you talk to people about banks, they are scathing about them. And it's not just banks, it's any large institution. You've got water company CEOs taking huge salaries while sewage is being disposed in rivers. You've got all of these news items that just push people to say, well, I'm not stealing off of Aunt Ethel here. I don't need to have scruples. They've got no scruples. So society is changing quite a lot, and that's behind some of this fraud growth, I'm sure of it. Systems complexity, it's much easier for them to find weaknesses in some of these systems that are being put in nowadays. We've talked about AI in other contexts. It's going to be important here as well, understanding the topology of these people, learning all the time from data that's coming in. Of course it's going to be important, but they're going to use AI as well, particularly the OCGs in the UK. You're going to have conflicting, almost an arms race between them. So let's not rely on it. I don't think it'll be the friend only of us, unfortunately. So, just to finish off, first thing is fraud's here to stay. It's a partner for life, and divorce is not an option, I'm afraid. So you have to learn to deal with it, and there is evidence to show that those companies that actually measure fraud see a reduction in it because they're actually focusing on it. And it's important to deal with fraud and the risk of fraud at the front end in life, but also at the back end as well. And I fear that debt sales are the friend of the fraudster, because actually you lose control of that data flow back. I don't suppose many of you get a lot of data back once you've actually sold debt. And I think it would be good with these sorts of portfolios to see what resources in there to help your future as well. So hopefully that was a reasonable canter through. Any questions? Thank you.
Yeah, the questions should come up on the screen. Through.
May need to put these on.
Got?
Do you find these customers put these? No, is the answer to that. As I said in the presentation, you know, they will sit within each category, and you'll find different excuses that are given by different people, but there's no early identifiers. There's not fraudster written across any foreheads, I'm afraid. It depends what pressures they've come under, what's caused them to do it. Some are opportunistic, some are, as I say, deliberate from the outset. So they can sit anywhere in a portfolio.
Has anybody else got any questions? Does anybody want to catch the box? I've got a quick question on AI and fraud. You know, AI is here to stay as well, and on the increase. Is there, in the future, you know, could the two correlate to catch the fraudsters or chase the fraudsters better?
Well, I think it will do. As I said in that, I think definitely AI has a role to play, but the danger is, I mean, we've seen with deep fakes, AI can be used offensively as well as defensively. So it's only ever going to be part of the suite, isn't it?
Okay. That's great.
Thank you
Thank you so much, Chris
Thank you.
Metalle. Thanks, Chris.